Let's talk about the potential that exists, because Devang clearly believes that there is the potential to take it 4 times what it is currently. Hemant Rustagi, Chief Executive Officer, Wiseinvest, and Santosh Joseph, founder of Germinate Investor Services, joining me right now. Hemant as well as Santosh, apologies for keeping you waiting. We were dealing with the AMFI numbers that came through, and once again, an interesting set of data and positive data to say the very least. But we're talking about credit risk funds today, and to that end, has anything changed in your mind? We have continued to see outflows in this category month on month for several months. Hemant, I'll come to you just by dint of experience. You've seen more years than Santosh has.
Well, I think, look, the credit risk fund today, if you look at and how they were a couple of years ago, obviously there's a lot of change. Obviously, the stringent rules that were introduced by the regulator after IMFS episode and a couple of other episodes, obviously will ensure that there is better liquidity. If you see the portfolio of the credit risk funds, the more broad-based level of concentration has gone down. The transparency is better because you get to see the coupon rate for each and every security. So in a way, I would say that yes, they are definitely better in terms of the structure as compared to what they were, but in terms of opportunity, you need to also look at what else is available for you and what is the emerging interest rate scenario. You can't be just looking at only one aspect. Just to know that when you're investing in a portfolio like what you see in credit risk fund, there are tenant risk of investing in that, but also obviously there is a potential of higher return. But that risk still remains, despite the fact that there are a lot of things that have improved. Today, in my view, you are at a time when you're going to see interest rate cut maybe in the next couple of quarters. So in a scenario like this, I believe that there are better opportunities available for investors. Maybe look at dynamic bond fund, maybe look at duration or gilt, rather than looking at credit risk fund at this moment, surely. Because the thing is that, look, there is a universe of 14 credit risk fund right now. The total AUM is roughly around 22,000 crore, and we've seen outflows happening every time. There are two funds, HDFC Credit Risk Fund and ICICI Credit Risk Fund, that account for 65% of the AUM. The total folios in this fund is less than 2 lakh. So, even the risk-taking investors are staying away from these funds. So for me, right now, I don't think it's a great option for investors. There are better options available in the debt space for them to invest for a time horizon of 2 to 3 years.
That's a fair point. Santosh, do you concur? And the last point that Devang made was that now is the opportunity for duration. I think Hemant is speaking about the same thing. But at some point, once the interest rate cycle is turned completely, the opportunity for credit will emerge. Do you concur?
I think so too, because we just spoke about now the industry being about 23,000 crores. Let's go back in time and see just when credit risk were popular as a category. That segment was well over 1.5 lakh crores in the credit risk category alone. Those bonds, if I were to take the net sum in other funds that were present as maybe almost a 2 lakh crore industry, today it's come down to 1/10 its size, and today people are scared because of the recency bias of the 1 or 2 episodes we've had. But the fact remains that globally, junk bonds or credit risk bonds, or however different names that we call it, are an interesting part of asset allocation in client's portfolio. I agree it's not for every investor. I agree it's not for the one that's looking for stable, safe investments within the fixed income portfolio. But one cannot always say, I will not look at this, especially when you have today such transparency, clarity as far as the portfolios are concerned. I think the point that we need to take home is that the industry today, as far as the liquidity for credit risk is concerned, is way different, way better, way more robust than what it was in the previous avatar. So therefore, credit risk should be considered for that set of investors who are willing to bet for high risk, high return within the fixed income sphere. And I think that will lead to automatically more and more interest, and more interest will lead to more and more growth of the credit risk asset space. But I think one cannot rule it out. All the facts that we spoke about, a softening interest rate regime, better ecosystem is good. But also don't forget, equity markets at an all-time high. There will be some thought at some level to rebalance your fixed income equity portfolio. Within that, book some profits from equity and put it into fixed income, and there, instead of taking the high risk of equity, you may take slightly better risk in fixed income to get a better yield. End of the day, everything boils down to net yield.
Yeah, that's a fair point. Hemant, a quick view on the two funds that you mentioned. Or are there at all any schemes that you like, or would you, is it a blanket avoid for you? And then I'll come, Santosh, quickly to you on your view.
No, Alex, it's not a blanket avoid. The thing is that risk profile of investor has to be very different. I mean, you need to have, the risk appetite to invest in such a portfolio. I mentioned about two funds. I think if someone has to look at funds which have done consistently better compared to maybe others, these are the two funds that I mentioned that one can look at. But again, like I said, we were just discussing the industry numbers that we're talking about. Money coming into sector and thematic fund and mid and small cap fund. Problem is that, when a particular fund is doing well, a particular category is doing well, investors kind of tend to forget what is the risk profile, what is their risk profile, and what is the risk profile of investor. I think that's something every investor needs to look at. So I'm not saying blanket avoid. You need to be very, very careful when you're looking at such a fund.
Santosh, last 20 seconds, sorry to, cut the time, but do you like any schemes in this category, and what's the strategy? How much should you allocate?
Frankly, we got exposure to both the funds. The reason is we like credit risk. We have gone with the two best and the biggest, because I think one factor that we don't kind of allude to more often is the liquidity requirement, and there is a general consensus that large AMCs with large OEMs and better infrastructure in place will be able to manage liquidity events. So therefore, I blanket won't write off credit risk fund. I think if you're able to look at the portfolio, look at the asset liability match or mismatch that is in the portfolio, and I think the investor understands the risk one is taking. I think whether the top two that we just spoke about or even the ones, as long as the portfolio is good, you can invest.
Which two are you talking about?
HDFC and ICICI.
Okay, fair point. Just wanted to put the names out there. Thanks so much, gentlemen, for taking the time. Pleasure speaking with you, and apologies for a curtailed conversation, but it was insightful nonetheless. That brings us to the end of this particular edition of